In this particular class, we're going to be solving an example, which I'm going to read out now. Zazu Limited is considering an opportunity to produce an innovative component which, when fitted into motor vehicle engines, would enable them to utilize fuel more efficiently. The component can be manufactured either using process Omega or process Zeta. Although this is an entirely new line of business of Zazu Limited, it is of the opinion that developing either process over a period of 4 years and then selling the productions right at the end of 4 years to another company may prove lucrative. The annual after-tax cash flows for each processes are as follows. Year 0 to 4, you can see the after-tax cash flows: 3,800,000, 1,020,000, 1,153,000, like that. You can see for process Zeta, you can see the year and you can see the after-tax cash flows. Now, the question further says, Zazu Limited has 10 million 50-cent shares trading at 180 cents each. Its loan have a current value of $3.6 million at an average after-tax cost of debt of 4.5%. Zazu Limited capital structure is unlikely to change significantly following the investment in either processes. Then they said Folic PLC. Now this is a proxy company because it's different from Zazu, so you should already know that that's a proxy company. Folic PLC manufactures electronic parts for cars, including the production of a component similar to the one being considered by Zazu Limited. Folic PLC's equity beta is 1.4, and it is estimated that the equivalent equity beta for its other activities, excluding the component production, is 1.25. Folic PLC has 400 million 25-cent shares in issue, trading at 120 cents each. 120 cents means $1.20. Okay, so its debt finance consists of variable rate loans redeemable in 7 years. The loans paying interest at base rate plus 120 basis points have a current value of 96 million. It can be assumed that 80% of Folic PLC's debt finance and 75% of Folic PLC's debt finance can be attributed to other activities, excluding the component production. Then they said both companies pay annual corporation tax at a rate of 25%. The current base rate is 3.5%, and the market risk premium is estimated at 5.8%. Required. Now, before I read the required, let me say that if you are in the exam, you don't read the question first. I think I've mentioned that many times in my videos, that you read the requirements. When you start from the requirements, it helps you to save time and to know what to look out for. From the requirements, you know whether you can answer the question or not. And in such exams, time is a limiting factor, so you don't want something that will be wasting your time. So the requirement says provide a reasonable estimated cost of capital that Zazu Limited should use to calculate the NPV of the two processes. This is investment appraisal. You want to evaluate those two processes, process Zeta and process Omega, right? They said include all relevant calculations. Then they said calculate the internal rate of return and the modified internal rate of return for process Omega. You know, they are considering two processes. Now they said you should calculate for process Omega. They now said that given that the internal rate of return and the modified internal rate of return of process Zeta are 26.6% and 23.3% respectively, recommend which process, if any, Zazu Limited should proceed with and explain your recommendations. Now, this example is the final example I'm going to solve on this aspect of investment appraisal when it comes to the methods. You know, we've been treating the methods in previous classes. And if you notice, about some months ago, I had put out one class on investment appraisal. While I was about to solve this example as my second class, that was when I realized that there's some fundamental topics we needed to understand before doing this thing, like cost of capital, cost of debt, you know, cost of how to calculate cost of capital, cost of equity. So that was why I had to go to the beginning and start from cost of capital, cost of debt, showing you how to calculate WACC before you can even understand investment appraisal. Now, apart from the fact that this question is asking you to evaluate a business, they're asking you to provide a reasonable cost of capital. So you need to have the knowledge of cost of capital to understand this class. Does that make sense? It does. Now let's proceed to solving this question. From reading the question, I believe that we understand the scenario that they've painted. So you just write, let me use a black marker, Zazu Limited. The first question says, provide a reasonable estimate cost of capital. A reasonable estimate cost of capital means what is the WACC, the weighted average cost of capital that will be used to evaluate this project. That's what they're asking you for. So you already know what to calculate, weighted average cost of capital. Now, to calculate weighted average cost of capital, you know that you will need your cost of equity. Does that make sense? Now, this cost of equity, to get cost of equity, you know that you will need your equity beta, right? Now, to get this equity beta, you know you will need your asset beta, which is your business risk. This is where the twist in the question is. What exactly should I do? There's so much information. They bombarded us with so much information. Where should I start from? Start from what they ask you for. Then you work back. Can you see? You are asked to calculate WACC, but to get WACC, you need cost of equity using the CAPM approach, right? Now, to get this cost of equity, you need what? Your equity beta, which is your risk, the finance risk of the business, because the finance risk of the business will change. Why would it change? Because they are going into a new business, and we've already said it before that once a company is embarking on a new investment, the existing WACC cannot be used. Do you understand? So the first thing to get now is what? The business risk. What is the risk attached to this new business that the company is doing? And how do you get the risk? You go and look at the company that is doing it before, which is what? The proxy company, which is Folic PLC. Now, what did they tell you about Folic PLC? They said that Folic PLC manufactures electronic parts for cars. They are doing what Zazu Limited wants to do. And they said that it is similar to the one being considered. That's just telling you that it is a proxy company. They now said that their equity beta, proxy details. Now, all this one is in your working notes. Just flip a page over, right? Your proxy details. What's the name of the proxy? Folic PLC. Folic PLC's equity beta, that's BE, is equal to 1.4. And it is estimated that the equivalent equity beta for other activities, excluding the component production, that is excluding the component that Zazu wants to go into. And that's what we are looking for. Can you see the twist in another twist? So what they are trying to say is that this is the equity beta, the overall equity beta. Let me write this boldly. The overall for the proxy company is what? 1.4. So the component that this company of concern, which is Zazu Limited, wants to go into is what? They didn't give you. You don't know it. But they gave you others to be 1.25. But they didn't give you the components that we are looking for. Because what we are looking for is the business risk. All I need is the business risk of the business that I want to go into. Once I get the business risk, I bring it to my own company, Zazu Limited, and I marry it into our situation. That is, I am trying to re-gear. Then I can now get our work. But they didn't give me business risk. They gave me equity risk. I've already explained what business risk and equity risk is in the previous class. So I need to de-gear. That is, I need to strip this finance risk of their debt elements. Do you understand? I need to remove the debt finance from it to get only the business risk. So you're going to ungear this. You ungear this, then you can now get the business risk. So to ungear your beta overall of the proxy company, BA equals BE times E over E plus D into 1 minus T plus BD times D over E plus D into 1 minus T. 1 minus T. Remember that this is the formula to ungear. So your BA overall, that's what you're looking for, the whole company. Because the company is divided into different segments, okay? So it's divided into other segments and component segment. And it's component segment business risk that we are looking for. Do you understand? So now that you have your BE overall, that's equals to 1.4 times what is the equity value? or the equity capital of the proxy company, because it's proxy details you're using here. They said it here that Folix PLC has 400 million 25-cent shares in issue, trading at $1.20 each. That is what you need. That's what you need, right? So it's going to be $1. Just go one side in your calculator. You don't have to write that one down. So your equity value of the proxy company, $1.20 multiplied by 400 million shares. Okay, so you put that in your calculator. Here's my calculator. 1.2 times 400 million, and that's 480 million. So that's 480 over 480 plus, what is your debt value? They said it here that the loan paying interest at base rate plus 120 basis points have a current value of 96 million. So that's plus 96 into 1 minus t. What's your tax rate? They said both companies pay annual corporation tax of 25%, 0.25. Plus, what's your risk of debt? Risk of debt here is not given. Once it's not given, it is 0. Okay, multiply by anything that is associated with that 0 will be 0, so you don't have to write that part. That makes sense. Then you have equals to, you do all of this, put this in your calculator. You start from here, right? That's 96 times 0.75 plus 480. So you say 480 divided by answer times 1.4. So that's 1.22. Can you see? So your business risk, we are getting close. Don't forget I said we're looking for business risk of the component aspect of the business. But this is the business risk of the overall. It's like you're looking for a treasure, so you have to keep digging. That's the twist in this question. Okay, so it's 1.22. So you put that aside, that the business risk overall is 1.22. We're getting a step closer. Now we need to get the business risk of other components. Okay, we need to get the business risk of the other components. Although this is what we are looking for, and we'll get there, we need to get the business risk of this one and this one for us to get this. Okay, so the business risk of the other aspect of the business, just like Dangote, they are doing semo, they are doing salt, they are doing sugar, but let's say it's only sugar you are looking for, so you don't get the business risk of the whole Dangote. You need to separate it. Okay, so the business risk of the other aspect of the business is 1.25. Okay, so you put that there, 1.25 times, now what is the equity value of the other aspect? This is the equity of the whole company. Now they said here that it is assumed that 80% of Folix PLC debt finance, 80% of Folix debt finance is attributed to other activities. Debt finance. So it's only 80% here, not in the whole 96.8 times 96. Does it make sense? See, I don't like when I'm explaining something and then it's now even getting more complicated. So let me know in the comment section if you're understanding. And they now said that 75% of Folix PLC equity finance is attributed to other activities. Just 75% times 0.75. So this 480 here is not going to be 480. It will be 480 times 0.75. Does that make sense? So now your business risk, which is your BA of other aspects of the business, will be what? Put that in your calculator. 0.8 times 96 multiplied by 0.75 plus this, which is 480 times 0.75. I'm putting that in brackets, equals, then say 480 times 0.75 divided by answer multiplied by 1.25. So that gives you 1.08. Okay, 1.08. So your better asset or your business risk of the other aspect of the business, this is overall. Your business risk of the other aspect of the business is 1.08. But what we are looking for is the better asset or the business risk of component aspect of the business. We don't know that. Now to get that, we don't need all this equity beta again. Okay, we don't need all of this again. We have already stripped out the business risk from them. Now to get that, to use the formula, there's a general formula for that, which says that the overall business risk of any company, the overall business risk is always equal to the business risk of the first aspect of the business multiplied by the weight of the first aspect of the business plus the business risk of the second aspect of the business multiplied by the second aspect of the business plus, if it's up to 15, right, just put n. So that is it. Now, what is the first aspect of this business? Other aspect and component business. Component aspect, right? And the component is what we are looking for. So your overall BA is what? 1.22 equal to, what is the business risk of the other aspect? 1.08 multiplied by, what is the weight? This is business risk, this is weight. So what is the weight here? Now, to know the weight of each of them, just assume that is the equity. Okay, whatever the weight of the equity is, that's the weight of each segment of the business. And they are told you here that 75%, right, 75% of Folix equity finance is attributed to others. So if 75% belongs to others, it means that 25% will belong to the component aspect. Does it make sense? So the weight of others is going to be what? 75% plus, this is what we are actually looking for, right? The beta asset of the component aspect of the business times the weight, 25%. So look at all the journey, and it's actually a very short journey. It's just because of explanation. It's because of, like, as I'm filming it right now, I'm sweating, it has already entered like more than 10 minutes. So it's because of the explanation. But in exam, because this particular calculation you're doing is just 8 marks, so you have to be very fast if you are trying to look for 50 marks to pass the paper. You understand? So you, after you solve this, now you're going to have your beta assets of the component aspect that we are looking for. So let's put that in our calculator. You have 1.22 equals 0.75 times 1.08. That gives you 0.81 plus 0.25 BA. Okay, so you collect like terms, that will be 0.25 BA equals 1.22 minus 0.81. 1.22 minus 0.81 divided by 0.25, and that will give you beta assets to be 1.64. Now, this is the treasure we've been looking for. You now take that business risk, that is the business that my company Zazu Limited wants to go into. I now know the business risk. Now I can properly evaluate. They could have given you the business risk straight away, but now this question is trying to test your understanding on cost of capital. Do you understand why the cost of capital class was very necessary now? So we have this business risk to be what? 1.64. For those people that were telling me, do the investment appraisal class, do the investment appraisal class. So this is the exact reason. So that when I say I expect you to know this, it's because I know that I've already done it on my channel, right? And that makes me really happy. So now that we have the business risk, let's go and get the equity risk, which is also called the finance risk. Finance risk. So you marry it into the situation of the company of concern, which is Zazu PLC. Okay. Now when you are now trying to get the equity beta, what you are trying to do is that you are trying to regear. You are trying to regear. So that will be BA plus BA minus BD D over E into 1 minus T. We have learned this formula in previous classes. We have used it very well, right? So this is the formula to regear. Now your BE, which is what you're looking for, will be equal to your BA of component aspect, which is what is your business, 1.64 plus 1.64 minus BD. Your BD is 0. It was not given. Check your question. Did they give you? Let's check before we conclude that it's 0. So there's nowhere in the question that they told you that your risk of debt, right? Debt risk, that's what it's called. There's nowhere. If they are silent about it, you just assume that it is 0. Okay. So that's 0 into debt value. Now, debt value of which company? Company of concern, which is Zazu Limited. Okay, that FOLIC is just a proxy, just for us to get their business risk. That was why we needed it. So you ask yourself, they said Zazu Limited has 10 million 50-cent shares trading at $1.80. That's what you need. Okay, so 10 million shares multiplied by $1.80, and that will give you what? 18 million. You don't need to be writing all these ones. Just don't need to even punch calculator. So the equity is what? 18 million. Then the debt is what? The debt, they said its loans have a current value of 3.6 million. 3.6 million. And an average after cost of debt of 4.5%. You don't need the cost of debt here. All you need is 1 minus t, and tax rate is 0.25. Okay, where you need the after tax cost of debt is when you're trying to calculate WACC, weighted average cost of capital. You know, when you're calculating WACC, you're bringing cost of equity and cost of debt together to get an average cost of capital for the company. So the next thing is to solve this. Okay, and you just start this way because of BODMAS rule. You multiply all of this first, then you add to this. This is the only thing standing alone. You don't start like this. You have just completely scattered your answer. Okay, so that's 3.6 multiplied by 0.75 divided by 18 multiplied by 1.64 plus 1.64, and that gives us 1.88. 1.88. So this is your finance risk, right? This is your finance risk of Zazu PLC. There was a former finance risk. Every company has its finance risk. Okay, now by virtue of you bringing in a new business, you have changed the finance risk. And once the finance risk change, the cost of equity will change. You can see how we are moving gradually. Okay, so the cost of equity is what? Your risk-free rate using CAPIM approach plus equity risk, what you just got, into your market rate minus risk-free rate. And the difference between your market returns and your risk-free rate is what? Your risk premium. So sometimes they won't give you market return, they just give you the risk premium. Do you understand? We pass this level, you understand it. So cost of equity equals your risk-free rate. I told you here that the current base rate is 3.5%. So you have 3.5% plus finance risk 1.88 into your they said, and the market risk premium is estimated to be 5.8%. Okay, just put your 5.8%. What it means is that your risk-free rate is 3.5%. So if you want to get your market return, is by adding 5.8. Do you understand? To it, but they already gave it directly, like your risk premium. So you just put that and put inside your calculator. What will you have? 1.88 times 5.8 equals plus 3.5. That gives you 14.4%. So the cost of equity of Zazu PLC is 14.4%. And when the cost of equity changes, the WACC must change. And the WACC is what they asked us to solve. Can you see how you are trying to look for 8 marks? Now you go and solve your WACC. Remember the WACC formula, right? The WACC formula says, let me clean up all of this, is equal to what? Cost of equity multiplied by equity over equity plus debt plus post-tax cost of debt. Can you see that? Multiplied by debt over equity plus debt. That's the WACC formula. Now take your cost of equity, 14.4%, multiplied by equity. What's value? We've gotten that already to be 18 million over 18 plus, I think it's 3.6 million for debt. Yes, 3.6 million plus cost of debt. They said the average after tax cost of debt is 4.5%. Just write 4.5%. Don't put after tax again. That is 1 minus 0.25, because they've said it that the average after tax cost of debt is 4.5%. So you don't need to post tax it again. Okay, multiply by 3.6 million over 18 plus 3.6 million. Now, what if in the question they ask you to go and calculate cost of debt? Maybe they told you that the debt is 10 years to redemption, trading at so naira per cup. Do you understand? You have to calculate it too. I've seen a question like that you have to. So you can see why cost of debt class or bond valuation class was necessary to continue investment appraisal. That makes sense. Now let's solve this. You dismantle this first. Okay, so that would be 18 plus 3.6, right? So 18 divided by answer multiplied by 14.4%, that gives you 12%, plus you do this side 18 plus 3.6, that's 21.6. 3.6 divided by 21.6 multiplied by 4.5%, that gives you 0.75. Okay, so 12 plus 0.75, your answer is 12.75%. So let's just approximate to 13%, because really it's very better to approximate, and they didn't say anything about approximation or to how many decimal points. So just put that 13%. So your work is 13%. Now after you've gotten your work, that is the answer to the question. What is, don't go and evaluate anything. They said provide a reasonable estimate cost of capital that Zazu Limited should use to calculate the net present value of the two processes. They didn't say calculate it though, that they would use to calculate. So what you just need to say is the reasonable cost of capital is 13%, and then you get your 8 marks. Okay, now let's move to B part of the question. The B part says calculate the IRR and the MIRR for process omega. They didn't ask you to calculate for process zeta, just process omega. So let's do that right away. Before we do that, let's go on a brief break. Okay. So to calculate your IRR, calculation of IRR, write your internal rate of return, okay, and MIRR for process omega, right? They said calculate IRR. The question is direct. What you need to do is put out your IRR formula. You have even told the examiner that, come, I know what I'm doing. Before you just go and start discounting, put out your IRR formula. Lower rate plus MPV associated with lower rate over MPV associated with lower rate minus MPV associated with higher rate into higher rate minus lower rate. We have used this formula many times in our previous classes, so you already know the formula. You now start asking yourself, where is my lower rate? Where is my higher rate? Where is my So that's where we'll now take you to discounting, okay? Because you can even get a mark for stating this formula. So, you know, we've said it before, right, in our previous classes, that what IRR does is that it tries to extrapolate between your guesses. An IRR is the rate at which the MPV is equal to 0. IRR is a break-even rate, so you can use that rate to make a decision that, if this IRR is less than my cost of capital, I must reject the project, right? Because you don't want to make a loss. So if the IRR is greater than your cost of capital, you can accept the project. When you are choosing between two projects that are mutually exclusive, when one IRR is greater, that's the one that you pick. That makes sense. So now ask yourself, where is my lower rate? So you go and discount. You just guess a rate, guess a lower rate, right? So guess a rate and start to discount the cash flows of process omega. So instead of guessing a rate, just pick the 13% that you have calculated, which is your work. So you say net present value, right? Because you have guessed a rate now, or a rate of 13%, right? The first rate you are guessing is what? 13%. So you are going to know if that rate will be higher rate or lower rate. Okay? Because you won't know until you're done with your net present values. So net present values from discounting at 13%. Okay? So you have your year 0, year 1, year 2, year 3, and year 4. What did they say about process omega? So let's check it. They said for process omega, they said their after-tax cash flows. So straight to the point. They didn't start giving you sales. You remember the previous question we saw? They gave you sales, variable cost. You're the one that was computing. What you need is your after-tax cash flows. They gave it to you as what? In the year 0, 3,800,000. So you write it, abbreviate to millions, right? 800,000. you have 1220. Here you have 1153. Here you have 1386, and here you have 3829. Does that make sense? That's for process omega. You have no business with process zeta in this question. So you need to discount. So you get your discount factor at how many percent? 13%. For year 0, of course, it will be 1.000. For year 1, let's check for year 1. It's going to be 1.13 raised power minus 1, right? That's 0.885. For year 2, 1.13 raised power minus 2, 0.783 raised to power minus 3. For year 3, 0.693. You can just be multiplying immediately, like just put multiply by, so that you just be writing it fast. Okay, so for year 4, 0.613. okay, now you start to multiply to get your present values, because NPV is sum of present values now. So in year 1, of course, in year 0, of course, you have minus. By year 1, that will be 1220 times 0.885. That's what? 1079.7. In year 2, 1153 times 0.783, 902.8. So year 3, 1386 multiplied by 0.693, and that means you need to be able to press calculator fast. And how can you press calculator fast if you are not practicing now? Seriously, if not, you go and learn it in the exam, and learning it will cost you your time. So that's 2347.2. So when you sum these present values together, so you got your MPV to be 1508.2, right? 1508.2. Now look at this. 1508.2 is a positive MPV, and you're looking for a negative MPV, right? The reason why you're looking for a negative MPV is because you need to get positive, which is a profit, and loss. To be able to stand on 0.0 of a number line, you need to have positive to the left and negative to the right, or vice versa, right? So you're trying to get a negative MPV, and to get a negative MPV now, you need to discount with a higher rate. The higher you discount, the lower the MPV. That makes sense. So discount to something higher than 13%. It means that your lower rate, since you are going higher, you already know your lower rate to be what? 13%. You know why we couldn't conclude from the beginning that our lower rate is 13%? Because you did not know. You didn't know if you were going to go higher or go lower, right? So you have your lower rate you have your MPV of lower rate to be what? 1508.2, right? That's a positive. Now your higher rate, go higher to just double it to 26%. Does it make sense? Then you now get your MPV of your higher rate. That MPV of your higher rate is expected to be negative. But what if it is not negative? Nothing spoiled. You continue like that. Okay? You continue like that. So let's discount at 26%. Hopefully it gives us a negative. But me, I know that it will not give us a negative. So since you are discounting at 26%, your cash flows will not change. It's your present values and your discount factor that will change, right? So in year 1, you still have your 1 point. In year 0, you still have your 1.000 discounting factor. In year 1, 1.26 raised to power minus 1. You can see 0.794 raised to power minus 2, 0.6298. That's 630. This approximation, it also kind of overstates figures, but it's just an estimation. Okay, you can't have absolute figures in investment appraisal when you are evaluating. Even if you have absolute cash flows, once you get to discount factor, those decimals will mess it up. But that is the appraisal, that is the gist of the whatever. So 1.26 raised to power minus 3. So for year 3, you have 0.445 49999. That's 0.500. 1.26 raised power minus 4 for year 4, you have 0.397. Okay, so let's get our present values. Of course, in year 0 it will still remain at 3,800. By year 1 it will be 1220 multiplied by 0.794, that's 968.7. 1153 multiplied by 0.630, that's 726.4. 1386 multiplied by 0.5, that's 693.0. 3829 multiplied by 0.397, that's 1520.1. So we're going to sum the PVs to get our MPV. Okay, so our MPV here is 108.2. 100 is not negative, although it's already going to negative because it's still going low. This one was 1508.2. This one is 108.2. Maybe if we had discounted it like 30%, if we had pushed it higher a little, but you can't push it too high. So to be on the safe side is to just double it. Okay, so that is going to tell you, that is indicating to you that your IRR, you break even at something greater than 26%. So once you are getting something like 15%, your ancestors should tell you that you are wrong. Do you understand? So you already know that my IRR will be higher than 26%. Now let's calculate our IRR. Since we already have our variables, you have your MPV of higher rate to be 108.2. Okay, so now let's get our IRR. You open to your next page and you solve for your IRR. All this one, no, this one are not in working notes. You are writing them down. You are writing them. It's not in working notes. There's not even working notes. Just write everything on a page and just grab your marks in any way you can grab it. So you have 13% plus your MPV of your lower rate, that's 1508.2, divided by MPV of your lower rate, 1508.2, minus MPV of your higher rate, 108.2. So if it was negative, it would have been minus, okay? But since it's positive, you just put your positive figure. Okay, higher rate, what is your higher rate? 26% minus 13%. That makes sense. So now let's get our IRR. You start by dismantling this, then you now add to what is here. Please don't start like this because it won't enter. Okay, this is board mass. This is board mass. In board mass, you see this thing is multiplication. It's multiplication. See, multiplication, it comes before addition. Okay, because this is one thing that I know that used to scatter people's answer. They've gotten the steps, but when it's time to just put it in calculator, or you can buy the natural display calculator and patiently press everything like this inside and just get the final answer. But you can also do it on this Casio calculator, this very common calculator. Okay, so what you do is, you already know that this is 13%. Okay, so just dissolve the denominator. That's 1508.2 minus 108.2, right? You got 14. Then say 1508.2 divided by answer, multiplied by 13, that's 14.00 plus 13 plus 13, so that's 27.0047. That's what? 27%. Can you see? If we had discounted at 27% and we're lucky to get a negative, you just know that your IRR is 27%, because IRR is the rate at which the investment breaks even. Okay, so your IRR is 27%. Now this question further said, calculate the MIRR. They said calculate the MIRR for process omega. Okay, and in our last class we did we've already done MIRR in one of the previous classes. I know that the formula for calculating your modified internal rate of return is what? The present value of the revenue phase over the present value of the investment phase raised to power 1 over n into 1 plus r minus 1. This is the formula. Present value of the revenue phase over present value of the investment phase over 1 raised to power 1 over number of years into 1 plus r, right? That r is your discounting factor minus 1. Okay, this r is your discounting factor, that is the cost of discounting, that is your work. the work that you used to get those present values of revenue phase, the work you used to get those so don't go and put your IRR here. So these are what I'm just trying to say, that this R is how many percent now? 13%, the work, right? For process omega, what is the present value of your revenue phase? The revenue phase in this question is from year 1 to year 4. That makes sense, because those are the places you have revenues, as in positive cash flows. Then the investment phase is in year 0. Okay, is in year 0, where you have is it minus 3,800? Yeah, but it's the present values of those cash flows, not the actual cash flows. So remember that we have done the present values. Now when we multiply by the discount factor at 13%, so those present values of the revenue phase, you add from that year 1 to year 4, right? Year 1 to year 4. Then for the investment phase, that was 3.8. That's 3,800,000. I just abbreviating. Now for year 4, for year 1 to year 4, one way you can get this revenue for year 1 to 4, that's the present values of revenue from year 1 to 4, is to just take your MPV. There was a particular MPV we got. Yes, this 1508.2, and just add it to 38. That's one way to get your revenue phases, okay? Or you add them one by one. You can just add them one by one, okay? So when you add them one by one, or if you use that method I showed you, you still get the same thing. When you add the present value of the revenue phases, you have 5290.2. Then this is for the investment phase, okay? So you put it into your formula. So you have your MIRR to be present value of the revenue phase, that's 5290.2, over present value of the investment phase, that's 3800, raised to power 1 over how many years? 4 years, into 1 plus R, that's 13%, 0.13 minus 1, okay? So you get your MIRR. So let's solve this now. Let's solve this. To solve this, how will you start? You do this. Look at it. This whole thing is multiplication. Then this is, you do this one last. It's just natural. Oh, look at board mass. You always multiply before you subtract. Okay. So let's do this one first. 5290.2 divided by 38. You have a particular figure. Then you raise it to power of 0.25, because 1 over 4 is 0.25. You can do that one aside quickly, so I don't start doing raised to power 1 divided by 4. You scatter everything again. So just say raised to power 0.25. Okay. Then you multiply by 1.13. Multiply by 1.13. Then you say minus 1, and that will give you 0.2274. So that's 22.7. Okay, you know it comes as 0.227. So you convert to percentage, that will give you 22.7%. Okay, let's just write that somewhere. This marker is fading. Let me take another one. So your IRR, just as you have saw, for process omega, your IRR is 27%, and your MIRR for process omega, MIRR that they asked to calculate, is 22.7%. Is at the end of the question. They still said something. They said that, which is now the end. They said that given that the IRR and MIRR of process zeta, you know this one we just did that for process omega. Now they're telling you that for process zeta, they assume that it is what? 26.66. That is, the IRR for zeta is 26.6%, and the MIRR is 23.3%. That's for zeta. See what they said? They said recommend which process, if any, Zazu Limited should proceed with, and explain your recommendation. So what do you guys think? Let's evaluate it together. If the MIRR, since the IRR of omega is greater at 27%. Is close though, but 27% omega is better, right? But for MIRR, zeta is better because zeta is higher. So that's what you write. Based on the computation, because that's the recommendation. You not just solve, you don't understand what you solved. Based on the computation of the internal rate of return and modified internal rate of return of process omega, it is recommended that ZASU Limited, if being evaluated based on internal rate of return, should go with process omega. However, if evaluated based on modified internal rate of return, process zeta is preferable. And in the previous class, or one of the previous classes, I had already explained the reason for MIRR, that there's a limitation with IRR. And the limitation with IRR is that sometimes your cash flows, they'll give you cash flows that in year 0, of course, the investment year, when they'll spend money. In year 1, you have inflows, year 2 inflows, year 3 inflows. Sometimes in year 4, you need to spend again. You need to spend a particular amount of money, you understand? Then year 5, you have your inflows. So sometimes there are multiple outflows. Another limitation of the IRR again is that sometimes in the last year, there's a high level of inflow and the IRR is kind of inadequate or is not able to capture the true, English is hard, it's not able to capture the true image of the investment because more of the cash flows is in the final year. If you see this question, right, see this question now, look at for process omega. You can see that for process omega, you have the highest cash inflow in year 4, which is 3,829, and even for process zeta, you have 5,990 for your cash flows in year 4. That's where the highest cash flow is. So because of that limitation, where the cash flows are not averagely on the same level among all years, because of that limitation of IRR, that's why some people, some financial managers will further evaluate using MIRR. But generally, both process are profitable. You know, these things measure the profitability of investment. Generally, they should accept this investment, or they can go on with the investment. But if you're evaluating based on IRR, process omega is better, and it's so evident in the cash flows. Sorry, this is just a further explanation in case you need it, right? But if you are just watching to just get the point, you can already click out. And it's evident in the cash flows. You can see that process omega, the cash flow in year 4, right, the net cash inflow is what? 3,829. See, the IRR is higher. IRR is doing well in that point, but it's not even able to do well in process zeta. You can see that the IRR is low, and the cash flow in year 4 for process zeta is 5,990. So higher than the average cash flows. In year 1 you have 643, in year 2 you have 546, in year 3 you have 1,055, and in year 4 you have 5,990. And that's one of the limitations of IRR, that once the cash flows are not evenly in the same range, the IRR most likely is not really appropriate to evaluate such investment style or cash flow style, right? So you can see that because Zeta's cash flows are like that, is MIRR that is bringing out the true reflection, the real profitability of the fact that that process Zeta is also profitable. Because if we did only IRR and we stopped at IRR, we say, oh, process omega is better, but process Zeta also has its highest cash flows in the final year. It has 5,000, which is even more than the cumulative of year 1 to year 3, right? So going further, using MIRR, it would let you to understand that process Zeta is also profitable, because based on MIRR, process Zeta is preferable to process omega, if that makes sense. So that's the end of this class. Thank you so much for watching. In our next class, we are moving straight to risk and uncertainty in investment appraisal. That one should take about maybe 1 class or 2 classes, and after that we go to adjusted present value and we proceed in investment appraisal. Thank you for watching. Don't forget to give my video a thumbs up. Don't forget to subscribe and also share with anybody that you know that will find this video relevant. Also, catch up on my other videos. I don't do, in fact, I don't film accounting videos. I film lifestyle videos, okay, and a sprinkle of accounting videos. So catch up on my other videos, okay, and share this particular one with anybody that you know is writing SFM or that will find this video helpful. And I'll see you in my next video. Bye.